In this episode, I'm going to break down a simple ICT strategy that works for swing as well as day trading. This strategy is simple and powerful and has a high win rate. So let's get straight into it. So today, I'm going to break this strategy down into 3 simple steps. Let's jump straight into the charts and start with step 1. This step is very simple, but if you mess this up, then nothing else in the strategy is going to work. So you need to follow this part exactly the way I explain it. My routine usually starts when I sit down at my charts around 12 p.m. The very first thing I do when I open the charts is mark out all the hourly swing points from the previous day, leading up to the current day's 12 p.m. It doesn't have to be only the previous day strictly. It can include all relevant hourly swing points until the current time. What I mean by that is I want to identify and mark all the clear and significant swing highs and swing lows that have formed on the 1-hour time frame, starting from the previous day's Asia session all the way up to the London session open of the current day. So when I'm sitting in front of my charts, I'll start marking out this high here, then this swing point here, and so on. But there's one very important rule you need to follow. We are only marking swing points that have not been traded into yet. So if you see a swing point like this one here, where price has already come back and traded into it, you are not going to mark that level. That level is no longer valid for this step. What we are interested in are the untouched swing highs and swing lows from the previous day or earlier sessions that price has not yet interacted with. So we go through the chart and mark all of those untouched hourly swing points. Now, if price starts trading beyond the swing points that we've already marked, then what we do is simply move to the next closest swing point that is still valid. This step gives us a clean framework of where liquidity is resting and sets the foundation for everything that comes next in the strategy. So now, looking at this specific day, you can see that we are at the 12 p.m. London session open. This is the point where we start our analysis for the day. The range we are working with is the previous day's range, and from that range, we are going to mark out all the swing points on the 1-hour time frame. For this model, 5:30 a.m. of the previous day is going to be our starting point for the range. From there, we simply look at price action and identify the clear hourly swing highs and swing lows that have formed since that time. These are the levels we are interested in because this is where liquidity is most likely resting. Once you mark out these levels, this is exactly how the liquidity sweeps are going to look on a day like this. Price will either run into one of these swing points or sweep it during the session. This step is very straightforward, and honestly, I believe most of you can do this comfortably without any problems. Once you get used to marking these levels daily, it becomes second nature and sets you up perfectly for the next steps in the strategy. All right, let's go through one more example so this becomes very clear. Again, we start at the 12 p.m. London session opening candle. This is the point where I sit down at my charts and begin the process. From here, I go back and mark out all the previous hourly swing points, starting from 5:30 a.m. of yesterday's Asia session. Just like before, I'm mainly marking the swing points that have not been traded into yet. Those are the levels that matter the most. You can also mark the swing points that have already been traded into, just so you have a visual reference, but your main focus should always be on the untouched ones. So I go through the chart and mark all the clear hourly swing highs and swing lows. Once that's done, I now have a clean map of the levels I need to pay attention to for the day. This whole process is very quick and very simple. As long as you understand what a swing point is, it should only take you about 5 to 10 minutes to mark out all of these levels. That's it. By doing this, when you go into the session, you already know exactly which levels you are interested in. You're not reacting randomly, and you're not guessing. Now this is where things start to get really interesting. Just because you have these levels marked does not mean you blindly trade every time price sweeps one of them. If you do that, you will get destroyed. I know this from experience because I lost thousands of dollars doing exactly that in the beginning. There is a specific confirmation that you must wait for after these levels get swept. Without that confirmation, the setup is not valid. And that's exactly what I'm going to show you in step 2. Before we move on, I want you to understand one thing clearly. If I had to stick to only one strategy for the rest of my life, this would be the one. All right, now that you understand swing points, let's move on together to confirmation because without this step, you're not going to get anywhere. This is where most people mess up. You see concepts like turtle soup or ICT liquidity raids and you think, okay, price swept a high or a low, let me just enter immediately and ride it back. And that's exactly what I did for years. I would see an old low like this get raided, I would immediately enter long, and the market would just continue trading lower, hit my stop loss, and then eventually turn around without me. I probably spent thousands of dollars and way too many years trying to figure out what I'm about to show you right now. Instead of entering a trade the moment liquidity gets raided, what we are actually looking for is a raid above or below a level, and then a closure back inside the range. This part is very important. If a candle trades below a level and then trades back up but is not yet closed, that is not confirmation. What we are waiting for is a candle close. That candle close is what helps you avoid getting into trades too early. So if you're watching this and you feel like you're always stuck on lower time frames, here's what you should be doing instead. You need to wait for higher time frame confirmation. If I'm looking at an hourly chart, I treat that hourly chart as my higher time frame. What I want to see is price raid one of these levels, either above or below, and then I want to see a closure back into the range on that same time frame. Until I get that closure, I do not look at lower time frames at all. And I know exactly where most of you struggle, because this is where I struggled for many years. I would sit on the charts, I wouldn't see anything on the hourly, so I would drop down to the 15-minute, then the 5-minute, then the 1-minute, and I would just keep scrolling through time frames until I found something that looked tradable. That is not proper trading. That is trading without a plan, and that is basically gambling. So what did I have to do to fix this problem of getting into trades too early? I had to force myself to wait for confirmation. This simple filter of waiting for a candle close back into the range completely changed my trading. It stopped me from front-running the market. I no longer entered trades just because a high or low got raided. I waited for the market to show me that it was actually willing to turn around. When you wait for a closure, that's when you know you're dealing with a high probability setup, because the market itself is telling you that it's rejecting those highs or those lows. So now you know how to find the levels, and you know how to wait for confirmation. But there's still one crucial piece missing. And this is the piece that took me from being break-even for many, many years to becoming consistently profitable. That piece is execution. So let's go back to the first example and walk through it step by step. Right now, all we're doing is waiting. We want to see if price interacts with one of the swing highs or swing lows that we already marked. We're not rushing anything. We're simply observing and waiting to see if price sweeps one of those levels and then gives us a candle close back inside the range. And you can see that on this candle, we actually get exactly that. Price raids the swing highs and then closes back inside the range. This gives us a very clean swing failure. What this tells us is that price attempted to continue higher and failed. We now have a clear rejection of that level. At this point, we finally have higher time frame confirmation. We have a raid, and we have a close back inside the range. That is our signal to move down to a lower time frame. So now we drop down to the lower time frame for execution. In this strategy, we are only using the 5-minute time frame for execution. And we only do this after the higher time frame has already told us which direction the market wants to go. Now that we're on the 5-minute chart, we look for our entry model. In this case, we can see a bullish inverse fair value gap forming. This gives us our execution model. Because we have confirmation from the higher time frame, and now an inverse fair value gap on the lower time frame, we can look to go long. So we enter at the inverse fair value gap, we place our stop loss below the recent low, and we aim for a simple 2-to-1 risk to reward. That's it. Now this part of execution is where things will differ from trader to trader, where you place your stop loss, where you place your target, and even exactly how you enter will vary depending on your experience, your risk tolerance, and your execution style. But what should be the same for everyone is the process that led you to this decision. We all start by identifying swing points on the higher time frame. We all wait for a raid and a close back into the range, and only after that do we move to the lower time frame to execute. Every trader watching this video will likely have a slightly different stop loss, a different target, and maybe even a slightly different entry. And that's completely fine. Once you have all of these things in place, the execution part is what you need to practice the most. This is the part that requires screen time, repetition, and experience. You can't just blindly trade a strategy and expect perfection. Sometimes your stop loss will be too tight and the trade will still work. Other times, your target might be too ambitious. Over time, you start to recognize these patterns. You'll learn whether you need to work on your stop loss placement, your targets, or your entries. And that's because execution has infinite possibilities. The strategy gives you structure, but mastery comes from repetition. So now that we have our entry and a logical stop loss placement below this low, let's play the candles forward and see how this trade actually plays out. Running through the process again, everything is aligned. Step 1 is plotting all of our swing points. Step 2 is waiting for the proper confirmation on the higher time frame. Once we get that confirmation on the hourly, it gives us permission to drop down to the lower time frame and look for an entry, a stop loss, and a target. Now, once you're in the trade, there's one more important thing you need to understand about exits. You should always have two types of exits planned. One is a fixed target, and the other is a time-based exit. When I talk about time-based exits, I'm referring to trading around session windows and kill zones. As you get closer to a kill zone close, you should be thinking about reducing risk. That could mean taking partial profits, tightening your stop loss, or moving your stop to break even. You don't want to hold full risk once the most active part of the session is over. Whether you choose to take partials or adjust your stop loss is a mechanical decision. There is no right or wrong choice here. What matters is that you decide this before the trade, not in the middle of it. This keeps emotions out of your execution and helps you stay consistent. All right, so that's the full process. You now have the exact same strategy that I used to make thousands of dollars and completely change my life. And I want to be very honest with you here. There's a good chance that some of you watching this have already had a profitable strategy before, but still didn't become consistently profitable. And I get that, because I went through the exact same thing. I failed for almost 3 years before I was finally able to make this work. But once it did click, my life changed forever. So please, whatever you do, stay consistent with this. Don't jump from strategy to strategy. Don't keep changing rules every week. Give this time, give it repetition, and let your execution improve naturally. Trading really can change your life if you have the right system and the discipline to stick with it. If you found this video helpful, make sure to like the video and subscribe to the channel. If you want to connect with me, you can join my Telegram and Discord. All the links are in the description. And if you want to learn personally from me, you can check out the mentorship program. The link is also in the description. I've also left prop firm discount codes down there if you're interested. That's it for this video. I'll see you in the next one.